As you mentioned, I think we went off for a good start into the year, and that is mainly, of course, on the back of a very good 1st of January renewal in our P&C reinsurance book. And I think the recent renewals, the April renewals, were characterized by a market environment very similar to the January renewal. So capital remained constrained with limited new capacity entering the market. Reinsurers continued to adjust prices and structures, I think, in a very disciplined way, which I do believe is needed. So most significant price increases could be achieved in the non-proportional property cat business. And accordingly, we continue to shift our portfolio towards non-proportional business and reduced our shares in proportional business. And I think the quality of the book has increased, which is now nicely reflected in the new accounting regime, in the contractual service margin for new business. That's a new KPI. And that went up by 60% compared to last year, which I believe is a nice reflection of the increased profitability of our book.
One of the challenges, I think this last 18, 24 months has just been, whilst you've been able to obviously improve margin and increase prices, you've also had to face the inflation of claims costs. And I'd be interested to know just how you think the key ratio on costs can be improved over the rest of this year, given that inflation is proving sticky.
Yes, absolutely. I think inflation, of course, has an effect on our business as well. I think with our cost ratio, which is in comparison to peers and to the market, always been very low. We are very disciplined on cost, and it's always on top of our agenda to also monitor costs. As for claims expenses, which are, of course, exposed to inflation as well, I think we have the possibility to react to inflation very quickly on the P&C side, adjust prices. And some of the price increases that you've seen are a reaction to the inflation. So overall, yes, inflation will be on the agenda. It will be elevated. However, I do believe we have a good toolbox to manage any impacts from inflation.
Clemens, really good to see. Now, hang on a second. Let me get this right. Your industry was moaning when the cost of money was very, very low because it had all the tourists coming in from the finance sector. And now you guys are worried about inflation. As far as I can see, the fact is you guys in the insurance industry and at Hannover as well are actually rather enjoying a higher cost of money on the back of the higher inflation, aren't you?
Well, you of course you have to manage inflation, of course. And again, we have the toolbox. We have also inflation-linked bonds. But overall, I think with inflation comes, of course, the increase of interest rates. And that is, of course, in the long run, very beneficial for our business. So I think overall, the increase, particularly on the interest rate environment, is a positive for us.
Yeah, there were a couple of numbers as well, which I thought looked really good as well. The combined ratio in the low 90s. Well, let me start off with that. Combined ratio in the low 90s. Is that sustainable, sir? Because that, of course, the further away you get from 100, just for our viewers' sake, below 100 means more profits.
Absolutely. I think it's a good start. I think it's a good baseline, the combined ratio. I should say that it is impacted by the new accounting regime. So structurally, the combined ratio went down a bit by the new accounting regime. I would probably say by roughly 2 percentage points. However, we have also, and what is included in the combined ratios, we've increased the resilience of our balance sheet in the first quarter. So that is all sort of in the combined ratio. But I do believe it's a good reflection of our profitability.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.